Wow, this is literally crazy. I'm looking at the recent market data crossing my desk right now, and the sheer volatility is just absolutely mind-blowing. We are talking about Plug Power, ticker symbol PLUG. This is an equity that has been throwing retail investors and Wall Street institutions into an absolute frenzy over the last few months. So welcome to The Explainer, everyone, because we are dealing with a situation today that frankly defies standard logic. I'm your host, acting as the designated devil's advocate for your portfolio, and today I'm joined by our chief investment analyst to decode the absolute madness happening with this hydrogen pioneer.
Thank you for having me. Listen, if we look strictly at the recent data feeds and market data from NASDAQ as of May 2026, the volatility you're referencing is indeed extreme. But we're not here to guess or speculate today. We are going to strictly analyze the underlying financial and operational data, interpret the actual SC filings, and present the real, fundamental causes hidden behind these wild news headlines.
Perfect. Let's completely strip away the noise. Our viewers are looking at their screens trying to figure out what is real and what is just a mirage. We need to know for sure if this is a massive turnaround story backed by real engineering or just another hype train heading straight for a financial cliff. Here is the roadmap for our analysis today. Number 1, the Plug Power paradox. Number 2, inside the financials. Number 3, the green hydrogen moat. Number 4, the AI data center pivot. And number 5, 3 future scenarios. Sounds like a solid logical plan. And remember, if you start throwing around abstract Wall Street jargon or getting lost in the weeds, I am going to interrupt you immediately. Our viewers need clear, actionable grounds for making investment decisions. Let's jump right into Section 1, the Plug Power paradox. Okay, there is a glaring contradiction staring right at us on the charts. Seriously. Explain this to me. How on earth can a company be a massive recent winner, up hundreds of % in a very short trading window, but simultaneously be a devastating long-term loser, down 86% over the last 5 years, and down a staggering 98% since its initial public offering in 1999?
It's a great question. The data tells a story of two entirely different timelines. The 86% 5-year decline reflects severe, long-term structural unprofitability. For years, Plug Power has engaged in massive capital expenditure to build out their vision of a hydrogen economy. That required issuing millions of new shares to raise cash, which heavily diluted the value for existing shareholders. However, the recent surge, which data from the Motley Fool places at an over 390% increase over a 1-year period at its absolute peak, is driven by a sudden selective repricing in the clean energy sector. Specifically, this recent momentum is tied to short-term operational cost improvements and massive emergent catalysts in artificial intelligence infrastructure, which fundamentally changes their total addressable market.
Wait a minute, doctor. Before we get into artificial intelligence infrastructure and total addressable markets, what does this company actually do? For the folks completely unfamiliar with Plug Power who just see the ticker symbol moving, give me a simple analogy that even an elementary schooler could understand.
Certainly. Think of Plug Power as the AA battery replacement for massive warehouse forklifts. Historically, logistics giants like Amazon and Walmart have relied on heavy, cumbersome lead-acid batteries in their electric forklifts. Those old batteries take hours to cool down and charge. Plug Power provides hydrogen fuel cells that swap right into those exact same forklifts. These fuel cells can be refueled in just 2 to 3 minutes, just like pumping gas into a standard car. It completely eliminates downtime in massive e-commerce distribution centers, keeping the global supply chain moving continuously.
Wait, seriously? So what you just said basically means they are the Energizer Bunny for massive Amazon and Walmart warehouses? They just keep everything running at full speed without having to stop and plug a heavy machine into a wall for hours?
Exactly. That core material handling business addresses a $14.43 billion global market, according to their own investor presentations. But as the financial data will show us next, building the complex physical infrastructure to support this fast refueling ecosystem has come at an immense, almost punishing cost to the company's balance sheet.
Okay, that brings us right to Section 2, inside the financials. They have a great product that saves logistics giants time and money. Logically, that means they should be making cash hand over fist. Let's look at the unvarnished numbers to prove if this business model actually works. If you look at the data from their official Q1 2026 earnings report, we see a distinct divergence between top-line growth and bottom-line reality. Revenue came in at $163.5 million. That is a 22% year-over-year increase, actually beating Wall Street estimates, which had projected around $140 million. So sales are demonstrably growing. Furthermore, their GAAP gross margin improved significantly, moving from minus 55% a year earlier to minus 13%. To understand why it was at negative 55% previously, we have to factor in the immense scaling costs, supply chain bottlenecks, and severe spikes in raw liquid hydrogen pricing they suffered last year. Moving to negative 13% shows that their internal cost controls and new production facilities are finally starting to create economies of scale. Wait. I am going to stop you right there. You just said their gross margin is minus 13%, and they have an operating loss of $109 million in a single 3-month quarter? What does that have to do with our stock accounts? Why is the market going wild and the stock surging when they are still running a $100 million deficit? They are literally losing money on every single product they build and sell. That right there is the absolute crux of the institutional debate. The market is not sharing the fact that they are losing money. The market is reacting strictly to the rate of improvement. The operating loss shrank dramatically from $178 million in the exact same period last year down to that $109 million figure. In equity valuation, particularly for highly distressed growth stocks in the green energy sector, a rapidly narrowing loss trajectory often triggers a re-rating of the stock price well before actual profitability is officially achieved. The market is pricing in the trajectory, not the current snapshot. Okay, I hear you. The bleeding is slowing down, they applied a tourniquet, but how much blood is actually left in the patient? What about this $150 million figure? Where is that coming from?
According to the consolidated cash flow statements, $150 million is the exact amount of cash Plug Power burned through in the first quarter of 2026 just to fund its day-to-day operating activities. To contextualize this massive outflow against competitors in the industrial sector, it is highly unsustainable without consistent external capital injections. The balance sheet shows they currently only have $406.87 million in unrestricted cash and cash equivalents remaining.
Oh my God. So what? They burn $150 million a quarter. They have about $400 million left in the bank. That means they barely have 6 to 9 months of financial runway before they literally run out of cash to keep the lights on and pay their engineers. This is terrifying. And the broader capital structure reveals even further severe constraints. The numbers prove that total debt currently sits at $1.01 billion. Furthermore, the company carries a staggering accumulated deficit of $8.2 billion over its lifespan. This is the result of decades of heavy research and development and building massive production plants long before end market demand had fully materialized.
That is staggering. Over $1 billion in debt and $8 billion lost since 1999?
Precisely. Because their liquidity cushion is so incredibly thin relative to their cash burn, they are highly vulnerable to macroeconomic shocks. This massive liability creates a severe mathematical risk of future stock dilution. When a company with high debt and high operating cash burn needs capital to survive, they typically issue millions of new shares to the open market. This dilutes the ownership percentage and voting power of existing retail investors, fundamentally driving down the value of the shares you already hold. This dilution mechanism is a primary risk factor explicitly documented by their own management in their SEC 10K filings. So what you just said basically means this company is burning cash like a giant industrial furnace, they have a ticking time bomb of a balance sheet, and if they don't fix it incredibly fast, retail investors are going to get diluted into oblivion. Which leads me to Section 3. Why would anyone in their right mind invest a single dime in a company burning this much cash? What is their irreplaceable weapon? What is the actual economic moat that stops them from just getting crushed by competitors or going bankrupt tomorrow? Their economic moat is their highly ambitious attempt at total vertical integration. If you analyze the competitive landscape, most rivals choose to focus on one single manageable niche. They either just build the electrolyzers that separate water into hydrogen, or they just build the fuel cells that generate the power. That's it. Plug Power's strategy is fundamentally different. They want to own the entire end-to-end green hydrogen ecosystem. Most competitors avoid this because the capital requirements are astronomical, and the supply chain logistics for cryogenic materials are immensely complex. But, as outlined in their corporate filings, Plug produces the hydrogen, liquefies it at sub-zero temperatures, transports it across the country via specialized cryogenic trailers, stores it safely, dispenses it directly at the warehouse, and builds the advanced fuel cells that ultimately consume it. So, they aren't just selling the AA battery, they are literally building the power plant, the specialized delivery truck, and the charging station too. That sounds incredibly expensive. It is incredibly capital intensive, which perfectly explains the $8.2 billion accumulated deficit and the $150 million quarterly operating cash burn we just discussed. However, from a structural long-term business perspective, this total integration is designed to secure reliable hydrogen supply, drive down per-unit costs at massive scale, and create high-margin, recurring revenue streams via long-term service and fuel contracts. Once this physical infrastructure is built and integrated into an Amazon or Walmart facility, the switching costs for that logistics giant become exceptionally high. They are firmly locked into the Plug ecosystem. But wait a minute. What does this actually look like in the real world? Show me the physical proof of these billions of dollars being spent.
If you look at the visual comparison, we see the sheer industrial scale of their green hydrogen production plants. Specifically, they recently started production at their new Georgia plant, which is currently the largest operational green hydrogen plant in the United States. And then on the other side, you see the simple, user-friendly warehouse dispensers that the forklift operators interact with daily. Bridging the massive gap between a sprawling industrial chemical plant and a simple, reliable pump inside a busy e-commerce warehouse requires immense engineering prowess, strict regulatory compliance, and billions in capital expenditure. This end-to-end network is their technological differentiator, but it is simultaneously the fatal weakness regarding their current liquidity crisis.
Okay, I fully get the moat. It's huge, it's expensive, and it clearly works for the forklift market. But forklifts don't make a stock surge 350% from its absolute lows. We both know the modern market only cares about one thing right now. Tell me about the sudden catalyst. Let's move right into Section 4, the AI data center pivot. The financial data indicates a massive, external, fundamental shift in the broader industry environment. The immediate catalyst wasn't actually a press release from Plug Power directly, but a monumental announcement from a direct competitor, Bloom Energy. Bloom recently announced a landmark partnership with AI infrastructure developer Nubius Group, worth up to $2.6 billion, with the first phase alone delivering 320 megawatts of power. To understand why this matters, you must understand the current technological bottleneck. Modern AI data centers, filled with tens of thousands of power-hungry GPUs, require an astronomical amount of electricity for processing and cooling. The traditional national power grid simply cannot handle these localized surges in demand, resulting in developers facing 3 to 5 year delays just to get connected to the grid.
So what? Bloom got a massive multi-billion-dollar deal. Good for them. What does that have to do with Plug Power's stock accounts? Why are Plug investors celebrating a competitor's victory?
Because it fundamentally reshaped the narrative and vastly expanded Plug's total addressable market literally overnight. The Bloom Energy deal decisively proved to skeptical Wall Street analysts that modular fuel cells are now a commercially validated fast-track solution to entirely bypass these multi-year utility grid delays. AI developers need clean, reliable baseload power today, not 5 years from now. By proving the technology is viable at a massive scale, Bloom validated the entire sector. Oh, I see. So it's a classic proxy play. Wall Street looked at Bloom's massive deal, did the math, and realized Plug Power has the exact same type of technology sitting right there on the shelf, ready to be deployed. Correct.
If you look at the product lines, Plug Power already manufactures Gensure stationary power units. These were originally designed and marketed as emissions-free backup systems for telecom towers and utility microgrids. Because Plug is fully vertically integrated, as we discussed, they can provide not just the hardware equipment, but the ongoing hydrogen fuel supply as well. Suddenly, a stationary power product line that was largely viewed as a secondary growth option is now perfectly positioned to serve the most capital-rich, power-hungry, urgent megatrend in the global economy.
So what you just said basically means they are aggressively pivoting from just powering warehouse forklifts to powering the entire AI revolution, simply because the traditional power grid is too slow and outdated to handle the AI gold rush. This is absolutely fascinating. But I need the bottom line forecast. We're at our final stage, Section 5, 3 future scenarios. How does all this historical data, cash burn, and AI hype translate into actual investment scenarios? Are we going straight to the moon, or are we going straight to zero? Before we model the specific scenarios, we must look at the strict, non-negotiable milestones established by Plug Power's own leadership. CEO Jose Luis Crespo has publicly committed to a very specific, ambitious profitability roadmap during recent earnings calls. The goals are achieving positive EBITDAs by the fourth quarter of 2026, achieving positive operating income by the end of 2027, and reaching full overall net profitability by 2028. Okay, so the clock is ticking loudly. They have until the end of 2026 to stop the heavy bleeding, or the institutional market is going to punish them severely. Lay out the exact scenarios for me so our viewers know what to look for. Let me break this down for you based strictly on the financial data and proven market trends. First, the bull case. This is the highly optimistic scenario. The specific precondition or trigger here is rapid, realized AI data center contract adoption, coupled with the company successfully hitting their Q4 2026 EBITDA's positive target. If they secure major AI power deals similar in scope to Bloom Energy and prove their internal margin improvement is sustainable, the expected outcome is a massive fundamental re-rating. The stock would surge higher based on a combined AI and clean energy premium, and traction from international projects like their 30-megawatt Barrow green hydrogen facility in the UK would prove their European expansion viability. Second, we have the base case. This is the neutral, most likely future based on current data trajectories. The trigger is steady but relatively slow material handling growth, combined with management's ability to bridge their immediate cash gap through aggressive asset sales. According to the recent filings, they are surviving right now by monetizing long-term assets. For example, selling $39 million in future tax credits and pushing a $142 million transaction with Stream data centers. The outcome here is a highly volatile, gradual recovery. Selling future tax credits for immediate cash limits their future upside, but it ensures short-term survival. In this scenario, they remain heavily dependent on U.S. Inflation Reduction Act government tax credits to keep the core green hydrogen economics viable. Finally, the bear case, the pessimistic worst-case situation. The trigger is that the $150 million quarterly operating cash burn continues unabated, and the promised AI expansion fails to materialize into actual signed contracts. The outcome is catastrophic. With only $406 million in cash and $1.01 billion in debt against an $8.2 billion accumulated deficit, they will face a severe, insurmountable liquidity crisis. This will inevitably lead to massive shareholder dilution through desperate new equity offerings or complete corporate failure and restructuring. Wow, the stakes are literally binary at this point. It is a desperate race between their visionary engineering brilliance and their own dwindling bank account. So, to give our viewers a one-line summary of this entire complex situation, I have to use a famous economic quote that perfectly fits Plug Power right now. The market can remain irrational longer than you can remain solvent. John Maynard Keynes said that, and it perfectly encompasses Plug Power's ongoing race against its own balance sheet. They might indeed have the clean technology of the future, but they desperately need the hard cash to survive until tomorrow. Thank you for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our video production. We will see you next time.